Getting started with investing can feel like stepping into a complex maze. It's easy to feel overwhelmed by all the terms and options out there, but don't let that stop you. Taking control of your finances and starting to invest early is one of the smartest moves you can make for your future. The good news is you don't need to be an expert or have a ton of money to begin. We're going to focus on simple, accessible options that have real potential to help your money grow over time. Let's dive into some of the best places for a beginner to start putting their money to work. These options are chosen for their relative simplicity and accessibility. They offer different levels of risk and return, so you can find what fits best for your current situation and goals. Remember, starting small is perfectly fine. While not a traditional investment in the stock market sense, a high-yield savings account is the absolute perfect starting point for building a financial foundation. Think of it as your first step into making your money work for you. These accounts offer significantly higher interest rates compared to standard savings accounts at big banks. This means the money you deposit earns more just by sitting there. It allows your savings to grow passively over time, compounding as the interest earned also starts earning interest. It's a simple but powerful concept. A major benefit is that HISAs are FDIC insured. This protects your deposits up to $250,000 per depositor, per insured bank, in case the bank fails. This makes HISAs an incredibly safe place to keep your money. They are also highly liquid, meaning you can access your funds whenever you need them without penalties. Because of their safety and accessibility, HISAs are ideal for building an emergency fund. This is crucial savings to cover unexpected expenses like medical bills or job loss. They are also suitable for saving for short-term goals you plan to reach in the next 1 to 3 years. This could be a down payment on a car or a vacation. Certificates of deposit, or CDs, are another low-risk option that can offer slightly higher returns than HISAs. When you buy a CD, you agree to keep your money deposited for a specific period. In return for locking up your money, the bank offers you a fixed interest rate for the entire duration of that period. This rate is typically higher than what you'd get in a regular savings account or even an HYSA. CD terms can range widely, from just a few months to several years, like 5 or even 10 years. You choose the term that aligns with when you might need the money. Generally, the longer the term you choose, the higher the interest rate the bank will offer. This rewards you for committing your money for a longer period. The key feature is that your money is locked in for the duration of the term. If you withdraw it early, you'll usually pay a penalty, which is often a portion of the interest earned. CDs are a good option for those who have a specific savings goal with a slightly longer time horizon than what an HISA is best for. Maybe you're saving for a down payment on a house in 3 to 5 years. They provide predictability because the interest rate is fixed. You know exactly how much your money will grow by the end of the term, assuming you don't withdraw early. Like HISAs, CDs are also FDIC insured up to $250,000 per depositor, per bank. This makes them a very safe place to store funds you won't need immediate access to. CDs can be a great way to earn a guaranteed return on money you know you won't touch for a set period. They add another layer to your savings strategy, beyond just a basic savings account. Now we move into options that offer potential for higher growth, along with a bit more risk. Exchange-traded funds, or ETFs, are a fantastic way for beginners to start investing in the stock market. Think of an ETF as a basket that holds many different investments, like stocks, bonds, or other assets. When you buy one share of an ETF, you are essentially buying a tiny piece of everything in that basket. ETFs trade on stock exchanges throughout the day, just like individual stocks. This makes them very easy to buy and sell through a brokerage account. One of the biggest advantages of ETFs, especially for beginners, is instant diversification. Because they hold many different assets, your investment is spread out. This diversification helps reduce risk. If one company or asset in the basket performs poorly, it has less impact on your overall investment because you own many others. Index ETFs are particularly great for beginners. These ETFs are designed to track a specific market index, like the S&P 500, which represents 500 of the largest U.S. companies. By investing in an S&P 500 index ETF, you gain exposure to the performance of these major companies. Your investment goes up or down with the overall market. Index ETFs are characterized by low fees, known as expense ratios. Because they simply track an index rather than requiring active management, their operating costs are low, and those savings are passed on to you. Their ease of buying and selling combined with diversification and low costs, makes ETFs a cornerstone for many beginner investment portfolios. They allow you to participate in market growth without having to research and buy individual stocks. You can find ETFs that track different sectors, countries, or types of assets, allowing you to build a diversified portfolio relatively easily. Starting with a broad market index ETF is often recommended for simplicity. If the idea of choosing specific ETFs or managing investments still feels like too much, robo-advisors offer a convenient solution. These are automated digital platforms that provide investment management services. You typically start by answering questions about your financial situation, investment goals, and risk tolerance. The robo-advisor then uses algorithms to build and manage a diversified portfolio for you. Most robo-advisors primarily invest your money in a mix of low-cost ETFs. The allocation of different types of ETFs, like stocks versus bonds, is based on your risk profile and goals. These platforms often include features like automatic rebalancing. This means the robo-advisor will periodically adjust your portfolio back to its target allocation as market movements cause it to drift. Robo-advisors offer a convenient and cost-effective way to start investing, especially if you're new to it. They handle the day-to-day management for you. They are particularly useful for those who lack the time, confidence, or expertise to manage their own investments. It automates much of the process. While they charge a fee, it's typically much lower than working with a traditional human financial advisor. This makes professional-style portfolio management accessible. Robo-advisors make investing simple and accessible, lowering the barrier to entry for beginners. They provide a structured approach to building a diversified portfolio based on your personal situation. They are a great option if you want a hands-off approach to investing. You set it up, fund it, and the robo-advisor does the rest, keeping your portfolio aligned with your goals. Choosing the right robo-advisor involves looking at their fees, minimum investment requirements, and the types of accounts they offer. Many are designed specifically with beginners in mind.